This is the Friday, January 27th, 2017 version of the Market Plus segment. Joining us now is Darin Newsom. Darin, welcome back.
Thank you, Mike.
We did not get a chance to discuss really the only bright spot in the world of ag commodities this past week, and that was the cotton market.
Right.
Continued to post solid gains, 214 to the upside on the nearby. What is cotton trying to do here?
You know, we finally found a market that isn't suffering from oversupply, that actually has some strong demand issues worldwide, and it's pushing the market up. I mean, we've seen the March contract really take off. Looks like it wants to target the 78 cents level. You know, it's a good, solid market. Now, if you look out to the December, it's not quite as bullish. You know, it may try to pull back a little bit. Everything might calm down a little bit by the time we get to new crop. But still, you know, it's trading in the mid to low 70s. So, you know, it's looking better than it has for quite some time. We have the right kind of buying coming into this market. And it looks like, at least as far as the old crop's concerned, that it could continue for a couple more weeks.
Okay. Now, do you think at these price levels we're starting to see cotton buy some acres back from beans?
Unlikely.
Okay.
But it's possible. You know, in certain areas of the country, it's possible. I think that could be some of the hesitation that we're seeing in the December contract. The reason that it's not quite moving as quickly as the March. This looks more like a short-term, short supply in a strong demand situation sort of play. And by all means, it could certainly help the market. You know, at least over the next month or so, maybe.
Be taking advantage of it.
I would.
Selling that old crop, I mean, do you wait for it to hit 78?
I wouldn't sell too soon. I mean, it's going to spike, but let's give it a little room in here. But the minute it looks like it's losing some momentum, I wouldn't hesitate.
On old crop, on new crop, same story. Continue to let it ride?
Yeah, it may want to ride the coattails for a little while, but again, I'm a little more concerned by the weekly charts on Dees than I am on the March. That, you know, it could start to falter in here.
Okay. Well, now, last week on this program, Darin, we had Angie Setzer on, and she and I had both received numerous questions from producers, as I'm sure you've heard out in the countryside. Tremendous basis affecting, a negative basis, I should say, affecting Holstein cattle feeders. And she and I had both heard stories, you know, from folks that we considered reliable, and we talked about it last week on the show. And after we talked about it, we mentioned some of the rumors that we'd heard. One of them we'd heard was that Tyson something had happened. They had quit buying Holsteins in the open market. So this week, we decided to dig in a little bit further, and executive producer Dave Miller reached out to Tyson Meats, and they responded. They got back to us, and they said they do continue to harvest Holstein cattle from existing long-term supply agreements. And they said, meanwhile, customer demand continues to drive the direction of our procurement needs. So that was their first statement. And then we asked, okay, was there any kind of conflict with certified Angus beef, which was the other part of the rumor we had heard, and Tyson said that is not true. Certified Angus beef is a USDA certified G1 program, and hide color and quality grading are not the only factors that must be met to qualify animals for the CAB stamp. So that was the response we received from Tyson. Certified Angus Beef also reached out to Market, and they sent us a list, and you can find it on their website, of all the quality measures that must be met to have beef be labeled CAB. So I encourage all of you to check that out. It didn't help us really to find an answer yet with what's happening in this soybean basis. Man, this Holstein basis, but Market will continue to look into it, and as we get more answers, we'll report it. Next question to you, Darin Newsom. Marty in Buxton, North Dakota. You're not a very sunshiny guy when it comes to the wheat market, but Marty's up in North Dakota. He's looking at that spring wheat market, that high-protein wheat. We have seen decent demand for that globally. He wants to know, what is the percent spring wheat stocks of total wheat stocks?
Yeah, you know, this is something that you and I touched on in our market discussion, is the fact that we have almost 1.2 billion bushels of total wheat stocks, 53.3% ending stocks to use, unheard of numbers. But after seeing that question, I broke it down a little bit, and if you take the spring wheat out, that's only 17.3% of total wheat stocks. So we've actually got a tighter situation in both ending stocks, less production, more exports, that's the things you mentioned, and that's why we've seen spring wheat just run away from the winter wheat markets. We've got inverted future spreads. We've got a stronger uptrend in the spring wheat market than we could ever dream of in the winter wheat market. And how long can it last? One of our major buyers is Canada of spring wheat. They didn't have as much protein as they needed, and we had some protein down here. So again, one of our trade partners. So to quickly blow the candle out on that little piece of sunshine, is how long can we continue to export if a problem arises?
Okay. Both Canada and Mexico signers to NAFTA, North American Free Trade Agreement,
Correct.
Which there is discussion of renegotiating in some capacity. Next question is from our friend Philip in Ontario, Canada, at Agridome, and he wants to know, Philip wants to know, is it realistic to think as of now to see more U.S. soybean acres than corn in 2017? And does the soybean price need to come down or the corn price need to go up before spring to even out 2017 planted acres? Will we see a reversion to that 2.4 ratio that we always talk about?
I don't think so.
Okay. Beans?
Not yet. Not
Okay.
yet. Not in the 17 crops, 17 contracts. We're not going to see that. And if we do, it's not going to be until harvest time that we see that type of correction.
Just because demand for beans has pulled that market so much higher?
Yeah, and we've got that undercurrent of demand. We've got the question of what's the ending stocks really going to be? Is it going to be 170 million bushels versus 420 million bushels? Is it going to even be down to 310 million bushels? Because that becomes beginning stocks for the next year. So, is it realistic to imagine a situation where we could see more U.S. soybean acres than corn acres? It's probably realistic to imagine that sort of thing. I'm still doubtful because of the U.S.'s tendency to, once we start planting corn, to keep planting corn. But if there is a market that's saying the opportunity is here, it's this year.
Well, you mentioned the tightness, the demand story that exists in winter wheat. I've heard a lot of soybean enthusiasm coming from the northern plains states. Is winter wheat buying some acres with these price levels? I'm not all that familiar with the price structure in producing wheat.
No.
Are we profitable in
No.
spring wheat?
No, in spring wheat's probably profitable.
Okay.
It's probably on the road to getting profitable, let me put it that way.
Beans are still a better choice.
Exactly, because of the protein premium. The minute the protein premium goes away from spring wheat to hard wheat, or at least gets cut back, then you're back into the old thing, well, wheat is just wheat, and one bushel's too many. One bushel left over is too many. So I think, spring wheat acres are probably going to stay about the same, maybe gain a little bit. Winter wheat acres obviously are going to lose some ground. And as you mentioned, up in the northern plains, they're really looking at going heavy in beans, pulling from some of the other pulse crops and some other specialty crops are probably going to lose ground. So I would say, at least from what I've heard, spring wheat acres probably going to hold about the same. Probably still see a pretty solid market, at least over the next month or so. Then we'll have to see if we're able to continue exporting.
Okay. Now, Darin, this program and then here during this Market Plus, we have danced around that confluence of commodity markets, supply and demand, and policies coming from regulators and legislators and presidential, new presidents, I guess we can say now. He's no longer president-elect. We've got a question from Glenn in Bryan, Ohio. As you look at that convergence of factors, in regards to the commodity markets, what potential presidential policies should be of greatest concern? And I wanted to ask this question of you because you are a technical analyst. So you watch the charts. At what point do policy proposals or perhaps even policy enactments overwhelm the charts, in your opinion, to drive a market?
I think we're there.
Oh.
Because the basic tenet of technical analysis is that it takes everything known in the market and prices it in before it's known in the greater public. But what we're dealing with now is nothing but unknowns. And so while, in our conversation of feeder cattle, I talked about the long-term trend. I see long-term trends in all of these different markets. They could all come unhinged. They could all get blown up here. What policy should commodities in general be concerned about? All of them. I mean, let's look down the list. Trade agreements, pipelines, everything. From energy markets to metals markets to the interest rates and so on. Grains, all of them.
Producers have to be on their toes.
They have to be on their toes. They have to be up on these latest developments, what's going on with policy, and not just sit back and say, oh, it's just Washington. No, these are going to have some real effects on not only the grains, but energy markets, livestock markets, and you name it, all of them.
Okay. Now, ordinarily, Darin, at this point in the program, we would ask you a commodity definition. Give us the definition of a term commonly used. But this week's a little bit different. We are excited to have welcomed to the Market to Market studios a group of young farmers from the Iowa Farm Bureau. They're here taking a tour, seeing how the sausage gets made in the world of television. And a couple of them had questions for you.
Great.
Several asked about the Holstein basis.
Right.
So we will continue to dig into that. But we also have a question here from Adam Smith. He's from Mount Pleasant. And we touched on this on the program, but he wants to know how much 2017 soybeans should I sell now or in the near future? As a percentage, how hedged do you want to be?
If I'm just doing options, I have no problem being 100% covered with options. If I'm out there doing hedges, that's pretty ticklish. The first big hurdle that we're going to get a couple hurdles coming up soon. That's in February, we're going to get the outlook forum from USDA, and they're going to kind of set, I don't know, people say it sets some sort of parameters. I think it's a waste of time. And then we get the prospective plannings report, which is just a little bit less of a waste of time because it's still just guesswork. But those things could certainly put the kind of an anchor on the new crop soybean market. So if I'm going straight hedging, probably going to be more aggressive than I usually am. 50% at least with the markets here in the 1020, 1030 mark. Then look for some opportunities for the market to dip down, buy some short-term options, some call options to go back against it in case we do get a spring-summer rally like we normally do, or we see the situation where we don't get the acres that everyone's talking about. So yeah, I would be more aggressive hedging.
Okay.
But also be looking for opportunities if the situation arises to get some short-term calls bought back against it.
Re-own it and find a way to capture some gains if and or when they come.
Right, and then when the spring-summer rally comes, get out of the options and you're back to your short hedges.
All right. Our final question is from a young producer, Donnie Conway, and he is asking, we talked about the feeder cattle market. You looked out 5 to 7 years in that cattle cycle. Donnie wants to know, on a short-term basis, less than 6 months, what can we expect if we're coming to the top of one wave? What's the next 6 months look like?
I would say initially we're going to come down. And as we talked about, usually when you get that pullback, that first pullback, so wave 2, you could pull back 75-80% of the first wave. So we could get within sight of that I'm just going to round it to 115 low from last October. We could get within sight of that, then hold, flatten out for a little while, then start to move higher again. Okay. So next 6 months, at least, initially what we're going to see is some pressure, then probably moving sideways, then start to move back up.
All right. And we should expect that wave 2 high to be a little bit higher than
Correct.
The wave 1 high.
Theoretically, that's what happens. I just looked at some charts where that didn't necessarily happen, but theoretically, that's what's supposed to happen.
All right. Well, Darin Newsom, thank you so much for taking the time to join us this week.
I always appreciate it. Thanks for having me on, Mike.
We enjoy having you. Join us again next week when John Roach joins me here at the Market to Market table. Plus, we'll look at how a plant disease is hammering Florida's citrus industry. And if you find value in our work, please consider clicking the Donate Now button on our website. So until then, thanks for watching or listening. I'm Mike Pearson. Have a great week.